All right, my friends, it is time for video 1B. In this video, we are going to look at getting pre-approved for a mortgage. You know your credit, you kind of figured out your down payment in 1A, and we're going to talk now about actually going out and finding out what you can borrow. So you've now addressed, like I said, your credit score. Hopefully you were able to look at that. Maybe you had to fix some things, get them taken care of. Now your credit score is hopefully in good shape, and then the down payment, maybe you're saving up right now for that down payment. You've found some ways to have some money for the down payment, or you're just realizing that you're not going to have a huge down payment, and that's going to be a factor in the pre-approval process. All those things are absolutely okay, but you have control over them, and that's what's important. So we're going to go to the master checklist like we do at the beginning of every video, and we can check off. Check credit and save down payment. You're working on that. You understand them. We can check them off on the master checklist. So what are we going to learn today? Well, we'll get the inside scoop on getting pre-approved for your mortgage. But let's start with a fun fact. In 2016, the average U.S. household had $171,775 in mortgage debt. So the average house has mortgage debt. Most people do have a mortgage on their home. Here's an average of what people have across the United States. Maybe you're going to be borrowing more than that or less than that. But I thought I'd just start off with that fun fact, give you a sense of where folks are. So let's talk about why we need a mortgage. Well, you most likely are not the only one investing in your new home. You got to have a financial partner. If you don't have hundreds of thousands of dollars in your pocket to just drop cash on a house, then you're going to have to get some money somewhere. And that financial partner is your mortgage lender, the people who are going to let you borrow the money. So step one in the process is not going out and looking for a house or anything like that. It's starting by knowing what you can borrow and applying for a mortgage. So how are we going to do that? Well, first we need to pick a mortgage lender. And this process is super important. You're going to see all sorts of ads out there, people who want you to borrow from them. And there's some ways that you can make sure you're working with the right lender from the very beginning. And here are some suggestions that I have. The first one is getting a referral. Referrals are great because these folks have worked with these lenders before and can tell you that they should be good to work with. If you ask friends and family, they'll have some insights. They have some limited insight sometimes, though. Friends and family have only done this maybe once or twice on their own. You don't get a mortgage every day. Insurance agents or realtors, though, are a great source of referrals because they deal with mortgage lenders all the time. So they really see over and over again what lenders do a great job and what lenders maybe don't take as good care of their clients as others. So insurance agents like myself or realtors are a great source of referrals for who you should borrow money from. I suggest going local. You know, having a local person is really important. Communication is the key when it comes to the mortgage process. There's all sorts of paperwork, all sorts of information, and if you're working with different people and an 800 number every time, it just starts to get confusing. Mistakes can be made, and the process can become very, fuzzy and frustrating. So having a local person is much more likely to get you a smooth, easy process than using, an online option or something like that. And you've got to expect great service. If it's off, move on. If you've called someone and they haven't gotten back to you for a few days right at the beginning of the process, that's a red flag and you should find someone else. Or if you just don't feel the vibe with the person or any of that kind of stuff, those are all red flags, and different companies will make it seem like they have the best interest rates and all this kind of stuff. And that certainly is a factor you should consider. But really, having someone who you trust and is going to have great service is a key to picking the right mortgage lender. Now, if you do want to consider an online option, nothing wrong with that. Obviously, the things I said in the last slide, are a factor. But if you do, here are some things to consider. At first, it may seem very easy. They want to make it seem easy from the very beginning so that you stick with them. But a lot of times, for reasons I already articulated, it can become more confusing in the middle parts of the process once you've kind of already gotten into the process and it's a lot harder to get out. So, think about that. It's much more likely that the interest rate will change. So they can give you a rate that's going to look good on the front end, but it may not be what you actually get in the end. If you're working with a local person, they're less likely to do that because they know they're going to have to face you, and they want to, from the very beginning, get you what you expect. Communication may not be as good, and watch out for adjustable rate mortgages. I'll talk a little bit about that in a second, but there's fixed rate mortgages and there's adjustable rate mortgages. A lot of times online options will try and get you in and make it look really good with an adjustable rate mortgage, but it could burn you later on. So those are just some little bits of inside tips on if you're gonna go with the online option. Now, in the workbook, you'll find on page 9 that we have some key terms, some things that you need to understand when you're talking with a mortgage lender and they're using all these words, you're not really sure what they are. We're going to solve that for you right now by just breaking down the most basic key terms associated with a mortgage. And the first one is principal. The principal is the actual money you want to borrow. If your house is going to cost $150,000, you're going to want to borrow, maybe $150,000 or $130,000. This is the principal, the actual money you're borrowing from the bank. The second thing is interest, and this is the extra money you pay the bank for letting you borrow from them. So they're not doing this for free. They're not doing this out of the goodness of their heart. They're making money off of lending you money, and the interest on your principal is the money that they make on top of what you borrowed from them. So interest is an absolutely key term and one of the things you'll be looking at as you decide which mortgage to go with. Annual percentage rate is a lot of times referred to as APR. And the annual percentage rate is the percent of the principal used to figure interest. Now, I've created a separate video down below that digs a little bit more into this and really breaks it down. But basically, you just need to understand that the annual percentage rate is what your interest is going to be based on over the course of your loan. Now, fixed rate mortgages. There's different ways that the annual percentage rate is set up, and fixed rate to me is probably the best option, especially if you're not as familiar with how lending works and how mortgages work. This is when the annual percentage rate stays the same through the whole loan, so you know exactly what rate you're getting, and if you're getting a 30-year mortgage, it will not change over the course of that mortgage, so it's very stable and very easy for you to understand. The second option is an adjustable rate mortgage. I already said that you want to be careful with these, but basically what it is you'll start with a certain rate, a certain percentage rate that the interest will be figured on. Over the course of the loan, though, it can change, and it can change on the way the market changes. So a lot of times you'll have a rate for, say, 5 years, but then after 5 years, the rate can change even on a yearly basis based on how rates in the industry are changing. And so it can be volatile. It can, if interest rates go up around the nation 5 years from now, then you're going to be stuck with a loan that has a higher interest rate. Adjustable rate mortgages are something you need to be careful with. If you understand finances, you know how it works, and you're going to get an adjustable rate mortgage that works for you, well, that's great. For the rest of us, a fixed rate mortgage is definitely the right way to go. And finally, mortgage term. The term of a mortgage is the period of time it will take to pay off the loan if you only pay the set monthly amount. Terms commonly are 15 years or 30 years. A 30-year mortgage, you're going to pay more interest because you're paying over a longer period of time, but you're going to pay less per month because that loan is spread out over a longer period of time. A 15-year mortgage, you're going to pay more per month, but ultimately over the course of the loan, you're going to pay less interest. So the shorter term you can do, the better. It's very common, though, for people to have 30-year mortgages, and that's totally okay. So let's now understand what you can borrow. Well, the best way to do that is to use an online mortgage calculator. And I'm going to bring up just an option here. I'm going to bring my browser up, and we're just going to have Google. The easiest way to really figure out how to use a mortgage calculator is just to go to Google and to Google mortgage calculator. And what you'll find is lots of different options. Let's go check this option out, mortgagecalculator.org. And so you're going to say, okay, well, what if I borrowed, what if the home was valued at $300,000, but I only got a loan for $250,000? The going interest rates right now are somewhere between 3 or 4%. So 4 is a perfectly fine percent to put there. The loan term, which we just talked about, let's use 30 years. We've got a start date here. They ask for a couple of more things that we need to figure out. Property taxes, I don't know, 1.25% is what they put in here, so we'll go with that. Private mortgage insurance. This is if you don't have a 20% down payment. So if you don't have a huge down payment, you probably leave this in here. Homeowners insurance, $1,000 a year is probably a fair number to keep it in there. And monthly homeowners association, most houses don't have a homeowners association, so we put 0 there. And then if we calculate, and then we can see right here, well, your monthly payment is likely to be somewhere around $1,600. So you're going to look at that and say, well, can I afford $1,600 a month on my payment? If I can, then looking for houses in this range up here is perfectly fine. If I can't, then I may need to change this and see what other options there are. Obviously, if we go down, we go to $200,000, and let's say we actually borrow $180,000. And we keep everything else the same. We calculate, and now that changes, and now we're more around the $1,200 a month range. So you can really get a sense right off with these mortgage calculators of, based on home value and what you think you would need to borrow, how much it would cost you on a monthly basis to give you a sense of, whether you can afford that or not. So let's move this browser out of the way. So using a mortgage calculator is a great thing to do. Another option is to, use what you pay in rent as a guide and say, okay, what am I paying in rent right now? Is it working for me? Am I able to afford it based on my job and everything else that's going on? And then look at that mortgage calculator and say, okay, well, if I'm paying rent in, $1,000 a month, let's try and figure out exactly what will get me to $1,000 per month mortgage payment. This is a great way to figure out what you can actually afford and, know that going in, so that when you go into asking a lender to pre-approve a mortgage for you, you have a sense of what you're looking for there. So use an online mortgage calculator and use what you pay in rent as a guide. Here are some documents that you should have together as soon as you go out to look for mortgages, because the mortgage companies are going to ask for them. Well, a driver's license or a passport is really number one. Your last 2 years of tax returns, you should have those together for them. Your last 2 years of W-2s, the document you get each year saying how much you made at your job. Most recent most recent pay stubs, so people can see what you're making. And then finally, your last 2 months of bank statements, so lenders can see really exactly what's going on with your expenses, your income, look at all those things together. So get all that stuff together before you even go out and talk to a lender, so that you're prepared from the very beginning and you can knock it out of the park. If you want to look at your workbook right now, there's a page that we have for you so that you can keep organized exactly what you're doing and who's offering you what. So this is the mortgage pre-approval page, and it has, what lender you're going, what lender you're asking, what the principal amount that was approved, so how much you asked to borrow. What's the term? How long is it going to be? Is it a 30-year term? Is it a 15-year term? Does the loan have a fixed or adjustable interest rate? Super important. And if it's fixed, what is the annual percentage rate? What's going to be the annual percentage rate over the course of the loan? And if it's adjustable, describe what's going to happen there. What's the rate when you start? When's it going to change? What will it likely change to? You may not know that because it's going to be based on where interest rates are at in the market at that period of time. But if you do know, you can put it in right there. So you're going to go out to lenders. You're going to give them all the information that they need from you. And then you're going to, put it right into this page so that you know exactly what's going on and you can get a sense of what your options are and what choices you're making. So let's talk about a rookie mistake. The rookie mistake is borrowing any other money or opening a credit card before your home closing. From the time that you get pre-approved to the time that you close on the home, you do not want to borrow any other money. You do not want to open any other credit cards because it can affect the loan terms themselves. They not only check your credit at the beginning of the process when you're pre-approved, but they're going to check it again at the very end. And if anything changes, then that's going to change your loan and change the terms of your loan. And at that point, you're deep into the process. You've already gone through all the other stuff we're going to talk about, and you're kind of stuck. And so don't go out and borrow any other money. Don't open any other credit cards. Make sure that you control your credit and keep everything stable from now until the end of the home buying process. So that's the rookie mistake, is borrowing other money. Okay, so what did you learn? Well, you got the inside scoop on getting pre-approved for a mortgage. We talked about how to find a great lender, some of the details of exactly how it all works. You're going to go out, find that lender, and get a great option right now. So what's next? Well, now that you're pre-approved for a mortgage, now that you've got the options, you've got the pre-approval, it's time to start doing the fun part. And the beginning of the fun part is going out and hiring a realtor. In the next video, I'll talk exactly about how realtors work, why they're great to work with, why the cost is not so bad in the end, and all those kinds of details. So I'm looking forward to explaining all that stuff to you all and talking about how to hire the perfect realtor for you. Okay. Time to head over to the Facebook group and share how you're feeling. What was surprising? What was confusing? What do you wonder? All those kinds of things. If you haven't been there already, go back to the dashboard. There's access down at the bottom of the dashboard there on the right. And you have to ask to get in because it's a private group, but we'll let you in and you can become a part of our community that's talking about their home buying experience, exactly how it's working for you. There's experts in there that can answer some questions that you have as well. So definitely go and do that. We are over there and ready to answer your questions. All right. I hope you enjoyed this video. I hope you're getting that pre-approval for the loan that you want. Looking forward to hearing from you in the Facebook group. Ready to talk about realtors in the next video. Until then, have a wonderful day.